Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're looking at Norfolk Southern stock. This will be the fourth stock in the Railroad series that was requested, and I do have a playlist created for this one now. So if you want to go compare them with each other, you can go watch those videos in the playlist. I think I'm going to set up a bunch more playlists for different industries too, and that way over time we can kind of build up for the people, kind of build up some analysis for the people that want to compare different companies in the same industry. As always, this is not individual investing advice. This is just how I analyze stocks. I also have a free tier over on Patreon and a $25 weekly picks tier. $25 a month. The picks are weekly. They've been doing well. So far, we've been ahead of the S&P 500 every week since we started that back in October. And people seem to really be liking it. For somebody that doesn't always like to pay up for stocks, it kind of forces me to just find the best deal I can each week, even if maybe it's not at the perfect buy price that I would like. So if you're dollar cost averaging or anything like that, or you just want kind of an idea generation place, that's a good thing to check out. And then, of course, I have the full Cyclical Investors Club service over on Seeking Alpha, and all those links are down in the description. All right, Norfolk Southern. This one, I actually had updated it in November, so it's kind of due for an update, and it had some positive changes since then. And so I actually had to go through and kind of reevaluate it based on kind of the improvement. So that was kind of good to see. Unfortunately for investors, the stock, it looks like it's already accounted for that. But, I mean, it's always, I've analyzed a lot of businesses where the fundamentals just really aren't that great. Like, there's not a whole lot of growth. And I mean, I get tired of being Mr. Negative all the time and pointing out all the flaws that I see that make things make things look not as good as they appear sometimes. That's kind of my job. But I really like when companies are growing and things are going well, even if maybe they're not at my buy price yet. So I'd rather have that happen than find something that looks good and then tell everybody why it's not so good. So anyway, let's get into Norfolk. I used to live in Norfolk, Virginia, actually. So down there they say Norfolk Southern, right? Somebody asked me what my accent was. It's really, I think, a Midwest accent, but I've lived all over. Okay, to the real analysis. If we look at earnings, which is the dark green shaded area here on the fast graph, generally it's up and to the right, which is what we want to see. Let me shorten this. We'll get it to this year and see what the earnings growth has been on the fast graph. So the other ones were about 14%. So these guys have been slower. If you're just looking at the earnings, they've been about we'll call it 9%. They are expected to grow this year. So if I bump that up, it was still about 9%. So, and we have these drawdowns. So we have a 39% drawdown during the Great Recession. I think that's fair enough. Not super cyclical earnings, but definitely moderately cyclical. And then during the industrial recession, when oil prices were collapsing and all that, we have a 20% decline, which kind of makes sense, right? So, but again, nothing crazy. Now the stock price, on the other hand, I'm guessing was probably fell more than 50. Well, I know it fell more than 39. Fell about, we'll call it 60% probably from the peak, since I just kind of picked random numbers. And I wouldn't be surprised if this drawdown here is similar in 2015, because I almost bought Union Pacific. About 45% here on this kind of mid-cycle decline, or I call it an industrial recession because that's really what it was. So we know the stock price can fall, let's call it 50%. When the market was anticipating that during COVID crash, again, in between 40 and 50%. So we should expect, in 2022 too. I'm just going to look at all of them now. So this one, they had some idiosyncratic things going. I want to say, was it like a chemical train hauling chemicals that derailed, and they had a big cleanup issue with that. And I mean, they had some other news and stuff. And I want to say that happened during this period. So that could have affected that a little bit. And then now we get the COVID bust as well. But if you look at the price, it generally follows the earnings. Pretty in line. They anticipate declines a little bit ahead of time, but not too much really. So no more than a year, like 6 months to a year, usually the market can kind of see the decline coming and starts to send the stock price lower. So I would call this moderately cyclical, but you want to make sure you're paying the right price for it because you know it can fall 40 or 50%. You also know you're going to probably get some opportunities that come along where the price is sold off and maybe the valuation is looking pretty good. Right now, the basic PE blended on FastGraph is like 20, so it's not super cheap, but we'll get into the valuation here in a second. So what I'm going to use, what I want to show here, I didn't queue up my buybacks chart, but I'll just tell you what they are. So if we look at, I'm going to use 2016. This is a little more optimistic too. So we're going to kind of start at this trough in 2016. Now we did have big tax cuts in 2018, which is why they grew 44% this year. I didn't control for that. I didn't try to exit out or anything. I just left it in there. So that's kind of optimistic. I did take into account this 10% earnings drawdown and this 15% earnings drawdown. And they've bought back, like I said, I didn't have my chart ready, unfortunately, but they bought back 26% of their stock over the past 10 years. So about a quarter of the company. And if you look at the earnings growth here, that's almost 10% during this time frame, not including these drawdowns. Well, this one would be included because it's lower right now. Once I control for those buybacks, I get a 6.35% earnings growth. So that's not too bad. I mean, compared to the other railroad company, it's actually a little better. And I also am going to adjust when I do my valuation for the difference between the market cap and total enterprise value. It's about 30% higher. So for the debt, so I'm going to assume the stock price is 30% higher than it really is. That'll produce a more conservative outcome. Now, the idea is you buy the railroad, you buy the debt, or at least add 30% more to the price to account for some of the debt, because I didn't do like a detailed analysis of it. How long would it take you after you bought it to earn your money back from the earnings from the company? And the way I like to do this is assume you buy the company for $100. How long would it take to earn $100 from their earnings? Okay. And we call that time until payback analysis. And we'll get to the spreadsheet here. Okay. So I have my 6.35% earnings growth. The real stock price is $242. I'm treating it like it's $315 because of that extra debt. So you're buying all that as the business owner, and I'm using forward earnings of $13.03. So that's actually, and that's optimistic, I think, because they're expecting 10% growth this year. So I'm pulling that year forward. I'm also pulling 6.35% growth forward on top of that. So that's pretty generous. Overall, I think I'm being reasonably generous, but about the same generosity as I was with Union Pacific and CSX, right? It was basically the same fundamental things that I did for them. So when you do that, you get an earnings yield of 4.14%. So that's the inverse of the PE ratio. So it's the earnings over the price, and I'm using this adjusted number as the price and this number as the earnings, and that will produce 4.14% earnings yield. So the way to think about that is if you bought the whole business for $100 as an owner, you would earn $4.14 the first year if there's no growth, but I add in the growth too. So, and what I want to know is how long it would take you to collect $100 on your $100 investment. So the first year we could collect $4.40. The next year we could collect $4.68. The next year $4.98. And we keep collecting that money, and how long until it adds up to 100, or to turn your 100 into 200. And it would be about 15 years. So that's my time until payback. So is that good? Is that bad? Well, right now the S&P 500 average, although the S&P 500 is falling a little bit, they might be closer to 14 years now, but it's been about 15 years. So to me, I think Norfolk Southern, using my assumptions here, is valued about the same as the S&P 500. When I buy a stock, I like to have it about 10. I like the time until payback to be about 10 years or less, obviously. So it's far away from a buy for me. We can test a couple prices here and see where it would become a buy. Because I'm trying to remember if I recalculated my other method, but not this one. But I'll just go in and I'll just test some prices and we'll see how low we need to go until we get to a 10-year time until payback. If I had to just eyeballing it, I'm going to say $115. Ooh, you can pay a little more than that, it looks like. So in between $120 and $125, yeah, right there, $125 is what we're looking at. $125 a share, that would have a margin of safety, and you would have a good, reasonable expectation to earn your money back in 10 years instead of 15 years as the owner. I think we probably need we would probably need a recession for it to get that low. I mean, in the past, we've seen those declines in the 40 to 45%. This is a little bit lower than that. Now, if they actually earn pretty well and the market gets negative at the same time, you could get the buy price to hit without necessarily having a recession, right? But typically, you're probably going to need some kind of economic slowdown for people to get super negative in order to get the price down there. Let's see where it got back here just a couple years ago. So that sounded pretty low, right? At 125 is what I said. But it was down at 184 just a year ago, a little over a year ago. And it was down at 125 in March 2020. So we can see a couple times, this time didn't even have a recession and it was starting to get close. So I think that's a good target to aim for. Now, if you just want to buy it at like fair value, then obviously you can pay more than that and you kind of maybe pick a point between where it's at now at like 240 and a point between there and 125. I don't know, 160 or something. Or maybe you could use this low as a reference. That might not really be low enough for my taste, but there's probably some technical support there. So if you're like, man, I really want to own this, but I just want to make sure I'm not paying too much, then like 185 would be a good spot to maybe start a position. You know, I like to have really good deals, so I kind of wait for those super troughs. Okay, if you found this useful, hit the like and subscribe button. If you have a request, let me know. I'll get the ticker up on the board behind me, and eventually I'll make a video for you, and I'll see everybody later. Bye.